If you make $100,000 a year and you save and put aside every penny that you earn, it will take you 10 years to have $1 million and become a millionaire. Now, it's unrealistic for you to put aside and save every penny of every dollar that you earn. So if now we're being more realistic and instead of putting aside 100% of every dollar that you earn $100,000 a year and then you save and put aside 20 cents for every dollar that you earn, so $20,000 a year. Now, it is going to take you 50 years to accumulate $1 million and become a millionaire. Now, the good news is there's better ways for you to become a millionaire than just saving 20% of every dollar that you earn, because most people who become wealthy, who become millionaires, don't do it by saving their money. There are 3 assets which have stood the test of time, which have made more millionaires than anything else. That is investing in your own business, is investing in physical real estate, and is investing in stocks. I'm going to talk about these 3 assets in this order, which are the most risky to the least risky, but also have the most upside to some of the least upside, but even the ones with the least upside have huge upside potential to make you not just a millionaire, but a multi-millionaire if you do it the right way. So make sure you stick with me until the end. That way you know how to do this the right way. And let me start by talking about building your own business, because this is one of the beauties of being in something like the United States of America, because you have the freedom to start your own business, you have the ability to start your own business, and you're not overburdened with regulations. Now, some of you might be watching this saying, but the United States has so many regulations. Well, if you go anywhere else in the world, you are going to be burdened by so many other regulations, making it extremely difficult to even start a business, where here in the United States, you have the ability to start a business. Now, if you've heard me talk in any of my other videos about building wealth, the secret to building wealth is understanding a term called equity. Now, most of us are familiar with the term equity when we talk about buying a home. People want to buy a home because that way you can, instead of paying your rent to your landlord, you can pay money to your bank and build equity in your home, because when you have equity in the home, you are building wealth. This is what we're all taught, and we're taught that home ownership is good because you can build equity in your home and pay off your home and build this sort of generational wealth, when in reality, this equity in your home is some of the worst kinds of equity out there. It's good to be able to own your home, but when we talk about where those dollars could have been spent, you have the opportunity to earn a better return investing this money somewhere else. Now, it comes back to that term equity. Where are other places that you can get this equity? You can build equity in stocks, you can build equity in real estate investments, not the home that you live in, and you can build equity in your own business. Now, if you want equity, because wealth is built through equity, there are 2 ways that you can get this equity. You can either buy this equity or you can build the equity. These 2, real estate and stocks, are primarily equities that you have to go out and actually purchase. So you need money to do that. The more money you have, the more of these assets that you can buy, the bigger the equity that you can build, and the faster that you can build your equity in those asset classes. When it comes to your own business, when we talk about building your own equity in your own business, you don't need a ton of money to start. What you need now is the sweat equity, which is now your time, your effort, your creativity, your labor, your hustle, your discipline, putting in that work to actually build a business. I can give you personal examples. I started here, Minority Mindset, with less than $500. It was significantly less than $500. I think it was only a couple $100, but we'll go with $500 just to make it an over assumption. I started making videos off of my cell phone under the alias Minority Mindset because I was working on a different business at the time, and I got scammed and screwed over during the launch of this other business that I was working on. And so I decided to start a class on a platform called Udemy. This class is no longer there, on how do you launch a business without getting screwed over. And I charged like $7 for the class, and people really liked it. And after that, everyone was saying, Jaspreet, can you please start a social media page with this whole Minority Mindset thing? So I decided to start an Instagram page called Minority Mindset, where I was posting the same stuff, how you can build a business, how you can manage your money better, because these are things that I was never taught. These were things that I was never encouraged to do. I was actually discouraged from starting a business. I was discouraged from investing. I was discouraged to learn anything about any sort of financial education, because I was supposed to be a doctor. My parents are immigrants to this country, and they really, really, really wanted me to be a doctor. Anything that was not a doctor was considered a failure. And so for me, I had to learn all of this myself because I didn't have entrepreneurs, I didn't have investors in my family that I could look up to. These were things that I had to figure out all by myself. So I started this Instagram page called Minority Mindset because it's all about the mindset of thinking differently than the majority of people. If you don't think differently than the majority of people, you're never going to become successful. That was the premise. And then people said, your Instagram posts are really good, but it's hard to read these captions because I would post these long posts about how you can build your business or manage your money. And people would say, can you go out and start a blog because it'll be easier to read? And I was like, well, starting a blog is very difficult for me because English is my second language. My first language is Punjabi. That's what I spoke at home. And so it would be difficult for me to go out and actually start this blog. Instead, I can talk. So I started a YouTube channel. I didn't go out and buy a fancy camera. I didn't go out and buy fancy lights. I didn't have a whiteboard. I had a white wall behind me. Now today I'm in Manhattan recording this, but before I recorded my videos off of my cell phone in front of a white wall. I didn't have any fancy audio equipment, and I bought like a $25 or $30 light from Amazon, and I bought a $25 or $30 tripod from Amazon, and that was it. I didn't have any fancy equipment. I just started making videos off of my phone, and that's how the whole Minority Mindset brand got started. Eventually we started to grow, and our channel grew, and with that, more opportunities grew. Our channel started to grow, and now I started to invest more time into the Minority Mindset channel because I really enjoyed what I was doing here. I didn't start Minority Mindset with the intention of making money. I didn't even know how you could turn on advertisements on your channel. Someone else had to tell me that I could turn advertisements on my channel because I didn't really care about monetizing my channel at the time. Then the channel started to grow, and then I started to spend more time on the channel because I really enjoyed it. And then I started to find other opportunities. Like one, I created Market Briefs, which is our free financial newsletter. If you haven't joined Market Briefs yet, I got the link for you down in the description below. I started Market Insiders, which is a financial education app. I'm now working on a tax firm that I'm working to build to help small business owners manage their taxes better. And so these are things that all started with a small investment, and that small investment of less than $500 has now grown into something significantly bigger. We have a portfolio of companies here at the Minority Mindset. We have a team of people, employees, some people who come into the office, some people who work completely virtually, but it all started with a small investment, but a whole lot of time. I worked a lot to build Minority Mindset. I was very dedicated to building the brand, to building the name, to building the presence. I spent a lot of hours, a lot of weekends, a lot of nights putting this together. And so this is where now understanding the equity, the valuation of companies. For example, Market Briefs is now significantly more than $500. It's significantly more than the amount of dollars that we put in to build it. But this equity that now I own is only worth something because of the effort that I have put in and the effort of our amazing team members. And this all started now again with a little investment. But again, this wasn't my first business idea. It took me a lot of different businesses to get to where I am today. Before this, I was working on a sock company. That sock company did very well. I was making a big profit with that sock company, but I decided to not go forward with the sock company because I wasn't very passionate about socks. Now, for the sock company to become successful, I had to go through a lot of hardships and a lot of hurdles. I got scammed when I started the company, but I had to learn how to market, and I had to go through all the lessons of how to do any sort of digital marketing when it came to that sock company. So that was a very expensive, very time-consuming lesson. And I also learned that because before the sock company, I started an Amazon store, where now I'm selling things not just on Amazon, but also eBay. We're selling products online. Things that we were buying from Amazon, things that we were buying from Alibaba and other manufacturers in China. But in order for me to do this successfully, I had to know how to talk to people. I learned how to talk to people because when I was in college, I worked on an event planning company that I started, where I was hosting parties, concerts, and shows. We got to the point where I was hosting 1 to 2 events every single week when I was in college. And this was very difficult on its own because now it was very time consuming, and it was difficult dealing with the people in the event planning company, dealing with club owners and bar owners, especially when I don't drink. I'm not into partying. I didn't even like the scene. That's why I had to shut that business down, because I started it because I thought it was fun, and then I ended it because I hated it. I realized that it wasn't an industry that I wanted to be in, but I was able to get my start in here because I got to meet a lot of the local DJs. Because I used to work at Indian weddings when I was in high school. I used to play an Indian drum called the Tol. So I used to go to weddings, play this drum. I got to meet a lot of the local DJs. And then we collaborated to start this local teen party company when I was in high school, and then that became my event planning company that I started when I was in college. So these things all built on top of one another. And yes, many of them failed, but everything taught me something. Some of them made me a lot more money than others. Some of them I really liked, some of them I didn't like, but I learned along the way, which allowed me to build and build and build and be able to produce content, which then allowed me to build more businesses, which is something that I really like to do. Now, building companies, building businesses is not easy. It's not for everyone. Entrepreneurship is very hard and it's very risky. You have to work a lot. All the people that are saying that you can work 6 hours a week from the comfort of your laptop on a beach and not have to stress about anything are lying to you. It is very difficult to go out and start a business, and all the risk is on you. However, when you don't know of your limitations, then nothing stops you from trying. And that's what it was for me, where I had no idea of the risks involved, of all the things that I was doing. For me, it was fun. I enjoyed entrepreneurship. I love the idea of producing something, creating something, building something. This is something that gets me excited, and it's something that I want to do, which is why entrepreneurship made sense for me. But this is where now you have to understand, is this something that you would enjoy, or is this something that sounds like a nightmare, something that's a big stressor, something that's a big pain to you? Because if you hate the idea of building something, creating something, having all that risk, having all that stress, and spending hours and hours to do something, hoping it's going to work and potentially failing and having to start all over, if you hate the idea of it, don't go out and start a business. But if you love the idea of it, go out and start a business, because I love entrepreneurship. I love the whole idea of working with entrepreneurs, but this is where you have to understand it is the most risk, it has the most upside, but it's also the most work. This brings me to number 2, which is investing in physical real estate. Now, the reason why I put real estate above stocks here is because to get started investing in real estate is much more difficult than getting started with investing in stocks, because you can start investing in the stock market with as little as literally just $1 nowadays. But if you want to go and invest in physical real estate, you need access to much more capital, you need access to more people, and it takes a lot more physical work. There's a saying out there that goes something like, real estate has made more millionaires than any other asset class. Now, it's hard to verify that, but you can understand where it happens when you understand how real estate works, because real estate allows for some of the best things possible in the investing world. You can get consistent cash flow, you can get appreciation, and you get some of the biggest tax breaks that our tax code has to offer. So the way that real estate investing works now is you're going to take your money and then you're going to go out and buy a property. Now, not all this has to be your money. You can use investors' money, you can use the bank's money, you can use the seller's money. There's many different ways to get access to this money, but you're going to need some of your own money typically to show that you have skin in the game. That way you can get started. There are some exceptions to this, but in general, you're going to need some of your own money. And then you're going to go out and buy a property. Now, you go out and buy this property with the purpose of making money. That's why when I talk about investing in real estate, it's different than buying the home that you live in, because when you buy the home that you live in, you're not buying it for the purpose of making money. You're buying the home that you live in for the purpose of making memories, to live there, to have something to raise your family. When you buy a real estate investment property, the analysis is very different. When you want a home to live in, you want a cute home. When you want a real estate investment property, you don't want a cute home, because cute homes are going to make you cute little profits. And when we're talking about investing in real estate, you want big profits, not cute profits. So now, when you're investing in real estate, the whole idea here is you want to have a building or a house or an apartment complex, something that's going to generate cash flow. You're going to have tenants that are living in your property or using a property, and they're going to pay you rent in exchange for your value. Your value is now owning this property. And now once you own this property, the tenants are going to have to pay you every month that they are in your property. So now that you start getting this cash flow, the key is now for this cash flow that you're generating to now pay for your property expenses. That means your property taxes, your insurance, your maintenance fees, your management fees, and your mortgage fees if you have some, and then put some money in your pocket. If you can do this correctly, now you have created a new stream of income from your property, and now your property tenants are now paying for all of your expenses and putting some money in your pocket every single month. And now you, if you do this correctly, can get tax breaks on the income that you're getting, because when you invest your money into one of these assets, you get tax breaks. The way that a system works is it benefits investors and it benefits business owners. Now, this can make you upset and angry, or it can make you educated and want to actually own the investments or the business. That way you can take advantage of these tax breaks, because this is how the system works. So now when you invest in real estate and you generate this cash flow, you can now deduct a piece of the value of your building against your cash flow every single year through something called depreciation. So if you make $10,000 worth of profit, typically you would have to say, hey IRS, I made $10,000 worth of profit. Now we'll have to pay taxes on this $10,000. But in real estate, it doesn't work like that. You can tell the IRS, hey, I made $10,000 worth of profit. This $10,000 is in my bank account, but I'm not going to pay you taxes on all $10,000 worth of income. Instead, I'm only going to pay taxes on $7,000 or $5,000 or sometimes $0 because of how much depreciation that you can get. Now, this depreciation size is going to depend on how big the property is and how valuable the property is. So you're going to depreciate, essentially take a piece of the value of the property. So if you paid $100,000 for the property, you're going to take a piece of that $100,000 that you paid, and you're going to deduct it against your taxable income, which means you have a smaller taxable income and a smaller tax liability. And then when you go to sell the property, let's assume that you bought a property for $100,000 and then you sell it for $1 million. Typically, you would have $900,000 worth of taxable income, meaning a big tax bill. But with real estate, it doesn't have to be that way. You can take all $1 million that you just made, go out and buy a bigger property that's going to pay you bigger checks every single month, that's going to give you a bigger depreciation deduction every single month, and you can pay $0 in taxes on this $900,000 of gains thanks to something called the 1031 exchange. This is a little loophole in the IRS tax code that allows real estate investors to flip properties for huge profits and pay nothing in taxes today. And this is completely legal. The IRS tax code says that you can do this. Now, there are a lot of complexities to this, so before you go do it, make sure you talk to a tax advisor in your area, but this is where you have to understand the value that real estate provides. Now again, we go back to the topic of equity. What are you doing? Now you're working to build equity in your real estate investments. That way you control the property, that way you can get the cash flow, the profits from the property, and that way now when you sell the property, you are the one that gets to capitalize on this equity, the appreciation, and then when you go and buy a bigger property, you're the one that owns it, you're the one that controls it, you're the one that gets the cash flow, you're the one that gets the profits, and then when you go and flip it again, you get that equity. This is where the real wealth is built. Wealth is built through equity, not just through your salary, because in America, the way our system works, I wish they would teach this in school, but the way our system works, there are two ways that you can make money in this system. You can make money through your labor, which is you going to work every single day and getting a paycheck. So your salary and your paycheck, this is your labor. This is what we're all told to work for, right? Go to school, get a good degree, get a job. Why? So you can get a salary. But in reality, in this economic system, that is the worst way to get paid, because now when you get paid for your labor through your salary or your paycheck, doesn't matter how big it is, whether it's $50,000 a year or $500,000 a year or $5 million a year, when you get paid through your physical labor, you pay the highest taxes, it takes the most work, and I mean, if you stop working, you stop getting paid. But now the second way that you can get paid is through your equity, through your capital. This is the way that our system works. And so now either you can build the equity or you can buy the equity. So now when you put your money to work and then your money makes you money, you pay less in taxes, it takes less work, and even if you don't work, your money is still making you money. This is why it's so important to understand this system, because becoming a millionaire is not rocket science. It's spending less than what you make and then putting the rest of your money to work. Or if you really want to, go out and start a business and hoping and working to make that business succeed. Of course, that's the most risk, but if you don't want to start a business, the alternative is just earning money, spending less than you make, and investing as much of your money into these two things as humanly possible. Now, before we move on to number 3, which is investing your money in stocks, if you do want to learn more about how do you actually invest your money and generate this type of passive income, me and my team have put together a free guide on investing your money for passive income, where it goes through how do you invest your money, how do you get these returns, and how do you manage your returns, and how you can invest your money even if you have not that much money to start. So even if you're starting with as little as $100, you can read this free guide to learn how to get started. So if you want to read my free guide on how to invest your money and start generating passive income, I'll put the link to how you can do it down in the description below. The third way to do this is just to invest your money into stocks, which is a way for you to invest your money into businesses without actually building a business yourself. This is what Warren Buffett does. Warren Buffett hasn't built an actual business. I mean, he has his investment firm, but he hasn't built a different type of business. He invests in companies. He invests in companies like Coca-Cola. And so he takes his capital, his money, and he builds equity in somebody else's company. And this strategy of investing your money consistently and aggressively made him one of the wealthiest people in the world. Now, you don't need to be one of the wealthiest people in the world to achieve this sort of financial freedom that you need in your life, but it requires you now to understand how do you invest your money in stocks and actually doing it. Because now when you invest your money into stocks, what are you doing? You're investing your money into actual companies. So if you're going to go out and spend money at Apple, you're going to spend money at Lululemon, you're going to spend money on Amazon, you're going to spend money wherever, now it's a matter of you flipping the script and actually investing your money to own a piece of the company. If you're going to spend your money at Apple, you might want to own a piece of the Apple company. If you're going to spend your money at Amazon, you might want to own a piece of the Amazon company. If you're going to spend your money at Airbnb, it might be worthwhile for you to own a piece of the Airbnb company. Now, this is the most rudimentary type of analysis that you can make, where if you're investing your money into buying their product, you might as well invest your money into the company. That way, own some equity in the company itself as well. But then, as you dive a little bit deeper, that's when you're going to want to start doing more deeper analysis into the investments that you're making in the stock market. Because the reality is, for most people, investing in individual companies is not the best thing to do, because when it comes to investing your money in individual companies, you need to have the education of how do you analyze a good investment, and then you need the psychological education of how do you manage your investment. Because what happens to so many people is they make an investment thinking that they're going to be a long-term investor, and then 6 months down the line, something bad happens in the economy, something bad happens to the company, and then they panic, and then they sell. And this is where you have to understand that if you're investing your money for the long term, you don't want to be paying attention to these day-to-day swings. You want to be paying attention to what's happening over the long term. So if you want to be investing your money into individual companies, great, but that means now listen to the earnings calls. Pay attention to what's going on with the revenues. Pay attention to what's going on with the profits. Pay attention to who is running the company. And it's not that hard to do this. Just search them on LinkedIn. Search them on Google. See what type of people they are. See their passion for that industry. And look at the type of products that they're creating. Is this something that's just needed today? Or is this something that's going to be needed 10 years from now? And how are they innovating for the future? Because you want to be investing your money into a company that's growing, not a company that's dying. So that's the first side. The second side is always investing in your own psychology, because if you're constantly just monitoring what's going on with the price of your stocks, it's going to make you more anxious and more scared and more worried about what's going on, and it's going to make you more likely to do things that you don't want to do that are not aligned with your investment strategy. So if you want to invest in individual companies, fine, but that's the type of analysis that you want to do. Now, if you say, I don't want to spend all the time and effort and energy researching companies, is there any alternative? And the answer is yes. For most people, what you should be doing is, instead of investing in individual companies, is just invest your money into low-cost ETFs or low-cost index funds and do this passively, automatically, and consistently. And this strategy can make you a millionaire, but it just requires you to stay consistent, to make it automatic, and keep it going on from now until the time you retire. How does this work? Well, it's a very simple strategy. Now, every time you get paid, you want a piece of your paycheck, the more the better, to be automatically invested into your portfolio of ETFs. Now, what is an ETF or an index fund? It is literally a group of companies. An ETF stands for an exchange traded fund, and it's literally a group or a basket of companies. There are ETFs out there that give you exposure to the biggest 500 companies on the stock market. It's called the S&P 500. There are ETFs out there that give you exposure to technology companies. There are ETFs out there that give you exposure into healthcare companies. There are ETFs out there that give you exposure to real estate. There's ETFs out there that give you exposure to emerging markets. There's ETFs out there that give you exposure to dividend paying companies. So you've got to figure out now what type of industry that you want to invest in. You find a few ETFs that you like, and now you build a portfolio of ETFs that you want. And now, anytime you get paid, you want to just passively invest your money into these ETFs. Now, if you do want to learn more about these types of ETFs, there's videos on my YouTube channel where I talk about the different types of ETFs that you can invest in. You can watch that if you want to learn more about specific ETFs that you can invest in. But this is where now all you're going to do is you're going to build this system. There's apps out there that will make it completely automatic that are free. If you want to see what I use, you can check out the links in the description where I post some of my links. Some of these are affiliates, meaning they compensate us if you use them, but these are the actual companies that I use. And so now it's very simple. No matter what's going on in the market, no matter what's going on in the economy, no matter what's going on in the world, Every time you get paid, you want some money to leave your account and automatically get invested. And if you do this and stay consistent with it, over time, you will see your portfolio grow, because now every time you invest more, you're owning a bigger piece of the equity. You're buying more equity every time you invest more dollars in there. And then over time, the goal is for your equity to become more valuable because your investments become more valuable. And this is where, if you believe in the American economy, if you believe in the future of America, then you should believe in the future of our stock market. Now, does this mean that it's going to be a straight line upwards? No. You're going to have volatility. You're going to have downtimes. We see recessions. Recessions happen consistently. I mean, they've been happening pretty much every decade. We see market downturns. This happens. But the goal is now, every time the markets go down, now you buy more equity. Every time the markets are up, you're still buying more equity, and the equity that you have is becoming more valuable. So it's just consistently working to build your wealth. And now, how are we building our wealth? Well, you're doing it through equity. You're buying and building equity here by consistently, passively investing your money. This can be the most hands-off way, and this is the most accessible way for regular people to become very wealthy by just investing your money consistently, passively, and automatically. Here with real estate, now you got to be more involved. You need access to more capital, but you can get some of the best tax breaks. You can get consistent cash flow, and you can build a lot of wealth through real estate. And then you have building your own business. Now you are building your own equity. This is the most involved. This is the most risky, but it also has the most upside because there's no limit to what you can earn here. And you don't need that much capital to start if you're resourceful, if you're willing to work, and if you're willing to learn. So if your goal is to become wealthy, the way that you do that is by building equity into assets that will work to grow in value. That way your equity can grow in value as well. There are three types of assets that everybody needs to own, whether you're wealthy or want to become wealthy, whether you're in a recession or an economic boom. These are three types of assets that every single person needs to own if you want to have any sort of real financial freedom, if you want to have any sort of real wealth. And these three types of assets are paper assets, tangible assets, and insurance assets. These two assets, your paper assets and your tangible assets, are going to buy you your freedom, and it's going to make you